risk and money management. Okay, so these are the things we have. Okay, we have trading plan, we have trading rules, we have trading journal, we have risk management and money management. Okay, so education first. Okay, so what is a trading plan? A trading plan, I have said that a trading plan is a written document. So it is a document, you write it down. So how do you form a document? So you have to get a pen, you have to get a book. So it is a written document guiding traders against their trading decisions and also avoiding them against emotions. Okay, so it just a written document, and in this written document it has some criteria. So the written document is going to contain an entry criteria. So it is going to contain an entry criteria, so it will have an entry criteria, it is going to have an exit criteria. So you have to write an exit criteria, you have to write an entry criteria, then you have to also write the risk part. Okay, now how much are you risking? Okay, so this is what is found in a trading plan. So in a trading plan there are benefits, so you are seeing about the benefits. So what are the benefits of a trading plan? So you understand that as time goes on, every trader has got all the things in line. Every trader who is making money in trading, he has got all the things, he has a trading plan. So let's take an example. Maybe you want to trade funded account. Now funded accounts, maybe you want to manage people's account. So you can't maybe manage someone's money without having all these things. So before you manage someone's money, you have to have a trading plan. We have talked about a trading plan. It should be a written document. Document it down, write it down. So in that document, what will be your entry criteria? So maybe your entry criteria is saying that liquidity sweep, a market structure, break, change of character, plus order block formation. Maybe you have unmitigated fair value gaps. So maybe you are waiting for 5 confluences before you enter. Okay, it is there in the plan, so you wrote it down. Okay, maybe the exit, you are exiting at the buy side liquidity zones, maybe you are exiting at the sell side liquidity zone. So that's in the plan. Now in the trading plan, you have indicated the risk. You are risking 1% of the account, you are risking 5%, or that is it. Okay, so the benefits, what are the benefits of a trading plan? So it's stopping you from over trading. Okay, then it is controlling your emotions. So this is what we have been looking at about this week. So I was showing you all of these things in the private class. Okay, so we talked about trading rules. What are trading rules? So we have talked about trading plan. What are trading rules? Trading rules, we say that these are set of guidelines. So these are set of guidelines in form of laws. Okay, they are regulations. In fact, these trading rules, they have regulated bodies. So we say that trading rules, you can see that most of the brokers have the same trading rules. Why? They have bodies governing them. They are regulated. Okay, so now these rules cuts across. Maybe the 1% rule, the 2% rule on brokers, maybe the 1% rule on that firm. So that's the trading rule. So these are rules and strict rules and regulation. They are guidelines. Okay, avoiding traders to be emotion. Now, but remember, what's the difference between a trading rule and a trading plan? So you should, as a trader, you should know it. So a trading plan can be changed. A trading rule is fixed. A trading rule is static. Then trading plan is flexible. You can change your trading plan, but you can't change your trading rule. Why? A trading rule is punishable. Maybe your trading rule says that you must risk 1% of the account. Maybe at that account they have given you 1% account. Maybe the rule is saying that the maximum drawdown is 10%. So if you go beyond 10%, so you are going to be punished. So rules are punishable. So the difference between a rule and a plan: rules are punishable, and rules, these are governed by bodies. So these are just governed by bodies. They are regulated. Okay. So they have terms and conditions. Those are rules. Okay. So we all have the similar rules. So let's say that maybe you are trading on exchange, maybe you are using OctaFX, maybe you are using XM, maybe you're using uh, any type of broker, maybe you're using just markets. So they all have rules, but each rule is punishable. So if you violate any rule, it's you are going to be punished at the end of the day. Okay, so we talked about it. So we also talked about what is a trading journal. So a trading journal, okay, this is it is in form of a spreadsheet. Trading journal helps in record keeping. So trading journal, it is like a system. It can be in form of database, it can be in form of spreadsheet, but you have to keep recording. So this form of system that helps traders to record uh, what the results are, and after the results it is called a trading journal. So that that uh, software that helps traders to record their data, to do what their performance, it is a trading journal. So in simple terms, now you're seeing that a trading journal is helping traders to understand their performance. So you are going to understand that without a trading journal, then you can't track your performance. Okay, so a trading is in tracking traders performance. So what are the things should be in a trading journal? So you are going to see that you have to know that maybe uh, what is your loss. Okay, so what is your loss, what is your win. Okay, so that's the most important now. So in a trading journal, you are going to see that what is your loss, what is your win. So in a trading journal, so that's the trading journal now. What is your loss, what has been your loss. Eh? So you are recording, and if you're recording, maybe you're using an automated trading journal. So you are going to see that maybe it is now it is going to be distributed in the form of a graph. Okay. So risk management and money management. So risk management is the process of protecting capital. So risk management focuses more on protecting capital. Okay. Then money management focuses more on growing money. So you are growing money over time through position sizing and compounding. So they are moving two things now: position sizing and compounding. So risk management, here you're protecting your capital against large losses. And how do you protect your capital? Maybe you've applied stop losses. So according to the risk, so you have to first understand your risk, then before putting your stop loss. So that's the thing: you understand the risk, then you put the stop loss. So there you're focusing on risk management. How do you protect your capital over time? So uh, most of the traders, the 1%, they have this thing in common: risk and money. Okay, so they have taken time to understand the risk. So money management, how do you grow your money over time? So how are you growing your money over time? Okay, compounding. So you have to have that feature of compounding future. Then you have to know how to compound your money over time. How are you compounding your money? Yeah, you have to compound your money. So position sizing, the number of positions which should be entered at that particular time. That's the most important thing now in that. So we also looked about trading psychology. Trading psychology. So trading psychology, at first I told you that what is psychology? Psychology is the study of human behaviors. Yeah? So you have to study human behaviors and emotions. Okay, maybe now what are the behaviors of humans? Human behaviors such as what? Humans are greed. We know very well that humans are greed. Humans fear. So if you become rich, if you have too much money, people are going to start fearing you in the okay. People will fear you. Okay, people fear good things and people fear bad things. Okay, so if that's the thing now, so the market is full of fear, is full of greed, is full of emotions. So now that's the psychology part of the market. So understanding the behavior part of it, understanding the fearing part of it, understanding the greed part of it, understanding the revenge part of it, then there you are understanding the trading psychology. Maybe you've heard of someone telling you, and like trading psychology. So trading psychology, that is what it means. Now trading, you know very well what is trading. Trading, now when you buy and sell, eh, or exchange of goods in profits, then you're trading. Maybe you buy and sell, but in between there, that difference in prices, now you've made profits, then you're trading. It can be physical or online. Okay, let's take a look of barter trade, then that is also trading. Let's take a look of other business people, also they are traders. Okay, yes, but this is what we call forex trading. Every business has its own psychology. Okay, so in trading we have our own psychology, then the people also in other businesses, they have their own psychology. So in any business you have to understand its psychology. So what's the psychology of trading? So what are the human behaviors in the market? Greed. Now you hold a position, you become overconfident after winning, that's greed. Uh-huh. Maybe you become emotional after losses. Okay, now after becoming emotional after losses, then you are going to see that fear, so you are going to fear to execute the setup. So that's part of trading psychology. So these are the things. So in any business we have these things, but more so in trading, then you have to understand what's your trading plan. So your trading plan should be there. Okay, we are beginning this new week, we are beginning this new month. What's your trading plan? Okay, what are your trading rules? Which rules are you following? What's your trading journey? What's your risk and money management? Now what is your trading psychology? Okay, so that's the most important thing now. All right, so we talked about these five things, and people have done their assignments. Okay, so today they have done their last assignment and they are finding them. So this is what the things you must be knowing as a trader. So as a trader, these are the things you should be knowing. Okay guys, so you have to understand it. Okay, then you have to understand this. Okay, let's take an example on this. This is a demo account, so we are going to demonstrate. All right, we are going to demonstrate. All right, now risk management. Okay, risk management. Okay, let's take a look. Now you have to know where, you have to know the, first of all, to apply proper risk management, then you have to know the bias of the market. Okay, so what's the market bias? So this is the most important thing. And now you are seeing very well that we are in a bull bias, so the market is in buys. Okay, so we are seeing a bias. Okay, so that's the thing. Now what is the bias? Now it is buys. Now then you have to look for buys. Okay, so you are seeing a rejection week down, then what are you seeing in the 4 hour? Okay, what are you seeing in the 4 hour? So you as a trader, you have to understand this now. What are you seeing in the 4 hour? Now you are seeing this. You are seeing this now. Okay, so we are seeing it higher. Now then you have to come and understand your risk. Then what is the risk part of it? Okay, what is the risk now? So the bias is bullish. Maybe you are trading smart money concepts, maybe you are trading support and resistance, maybe you are trading ICT. Then what is the bias now? Okay, you are seeing it. Okay, you are seeing it, and you are seeing the chart is forming some slight patterns here. Then you can see, you can tell. Okay, you can tell that maybe this chart is forming some patterns. Okay, so you can see the market. So what is your risk now? Let's take an example. If you execute from here, then you have to set your stop loss below here. Okay, let's take a look. For example, let's execute a buy. So what's the risk? So the risk, okay, let's say buy, then you execute a buy. So you have to set your stop loss around here. So where is your stop loss? Now as a trader, first you have to first manage your risk. So risk is first. Then you have to first manage the risk. So the stop loss is going to be below this structure now, you can see below, slightly below here. So what are you losing now? So you are losing $3. Okay, so this is the risk part. Okay, now this is the risk part of it. All right, now so you can see, you can see now. Then after executing it, then now how do you manage your trade as a trader? So you have to ask yourself, how do you manage your trades? Okay, how do you manage your trades as a trader? So that's the most important thing. How are you managing your trades? Okay, so I'm showing you this example. How do you manage, how do you manage your trades? Now we are seeing these live examples. Okay, so I'm showing you this example now. Let's take a look. Now stop loss should be set below here. Then what is your target? So your target should be around, so your target should be around here. Okay, should be above the structure. Okay, should be above the structure, should be so you are risking, $3 to make $4.2. So you can see now, you can see, so the risk to reward is somehow good. Okay, but first of all, I first told you that, so what's the structure? So the structure is bullish. So what's the risk to reward now? So we target now, so this is our first nearby liquidity now here. Okay, so you can see now the risk is now on $100 account. Now we are risking 3%. So we have risked 3% of the account. Okay, so 3% to make how much? Okay, so now if you measure this setup, then you have to understand which setup is this. So here is our entry. So our setup is, what's the setup now? Setup is one to what? So our setup, you can see it. So our setup is 1. Our setup is 1.4. Okay, so this one divided by this one, our setup is 1.24. 1 to 2, it is 1.1 to 1, 1 point something. Okay, but it is a good setup. Or we would have risked 1 to 2. We're risking $3 to make $6 around here. So around here, so this is the best target around here. So that's the best target. Okay, 1 to 2. So you risk this one to make that one. Okay, so this is $100 account. Okay, let's talk for a trader who goes maybe full margin, maybe. So this is a 15-minute time frame. You are seeing the charts. Okay, you are seeing that price, there is some sort of here, and you can see it. You can see that around here. So the market at this time is in another phase. Okay, the market is another phase now. In other words, if you check on the 4-hour time frame, you can see. Okay, if you check on the 4-hour time frame, you can see that the market has a lot of more to do around up here, has a lot of work to do around here. So you can see it. So this is just an example, guys. Don't take this trade. Remember, this video is education. Okay, so don't take the trade, guys. Okay, so yes, don't take the trades. So don't take the trades. So you can see it here. So you can take the trade. So don't take the trade. So you can see it here. So what's the risk to reward? So what's the risk to reward? Then you have to understand, what are you seeing now there in the market? You have to understand it. Okay, So now, for example, a trader now, maybe you want to test your strategy, then you have to test your strategy with the right proper tools. You can test your strategy like this. Yeah? Apply proper risk management on the account. Okay, 1 to 1, 1 to 2. Okay, 1 to 1, 1 to 2. Eh? You can see it. Sorry. Okay, so this is it. You can see it around here. You can also see it. So now you can see around here. So this is the 4 hour time frame. We said like this. This is the 1 hour time frame. Hmm? Then what are you seeing? Hmm? Then what are you seeing, guys? Okay. So in most cases we trade. In most cases we trade what? 15-minute time frame. Okay. Then you have to execute your trades. Okay. So now for setting our BE, we only set after what? 10 pips. Now it depends on the spread. So the spread is too wide here. You can see the spread. The spread is too wide. So since the spread is too wide, so it is recommended to set the stop loss times 2. The what? Stop loss. Okay, guys. So you can see there. You can see it there. So this is the best example for you guys. You can see there. So this is what I was talking about. Risk management. Money management. So risk management is first to protect your capital. So you enter trade. So after entering this trade, so risk management, after entering a trade like this, then you have to protect your capital. How do you protect your capital? By setting a stop loss. So money management. Then money management means that how many positions should you enter at this particular trade at this time. So depending on the trade you're seeing, that's money management. Okay, which lot size should you execute in? Okay, the lot size, which lot size should you execute in? Yes, so that's the biggest question now. Okay, trading plan. Then you ask yourself, are you following a trading plan? So what is your trading journal saying? So have you followed the right entry? Maybe you are entering after the sweep, maybe you are entering after the what? So you can see that this market was ranging up and it was forming something like this, and you can see but now you can see that we are ranging down, and regardless, this is an ascending triangle. Okay, so this is an ascending triangle. So what does it mean? An ascending triangle, here we shall see that the market is going to be bullish. So this market, the way it is moving now, it is a bullish market. Okay, ascending triangle. Okay, so how does it form? Or someone can call it a rising wedge. So this is a bullish rising wedge. Maybe price came like this. Price came, hit there, hit, come here. Or maybe in a ranging market we could see something like this, and we could see something like this. It's very possible. Okay, that's the what for stubborn pairs. Okay, but that's the point here. So that's the point. Now, how do you manage your profits and how do you manage your losses? So that's the most important part now here. So it means that when you execute a trade, then you have to what? Then you have to understand your risk. Now, after understanding your risk, then you have to also control the risk. Now, how do you control this loss? Okay, how do you control this source? So controlling this source, it means you can go on reduce it. Okay, controlling the loss, you can reduce the loss up to here. Or you can say that maybe now it's below this. Then you reduce the loss. As simple as that. Now this is now what we call risk and money management. Okay guys, so you can see it guys, risk and money management. All right guys, so let me stop here for today. So thank you for attending guys, and thank you for watching. Okay, yes, so thank you for watching. So you've seen now, so those of you who have come early, you've seen. So I've told you that how do you execute a trade. Remember, this is a demo account guys, but whether demo or live, the principles remain the same. So I've explained to you how do you take your trades. How do you take your trades? So the most important thing is, if you execute a trade, you have to first understand your risk part. Okay, but before taking a trade, then you have to understand your at first guys, I told you those who are late. Okay, let us close. Okay, those who came late, you have to understand your bias. Now the market is buying. You can see the market is buying from the bottom here. So the market is buying. The market is buying after what? After liquidity sweep. Okay, let us close this one. Okay, the market is buying down after liquidity. So this is what we call liquidity grab. So there's a difference between liquidity grab and liquidity sweep. Okay, some of you even don't know the difference. So this is the daily time frame. So liquidity grab, if you see any rejection week, that's a liquidity grab. So a liquidity sweep is somehow like this. Okay, but this one, these are grabs. So the liquidity grab occurs during high impact news, maybe opening of the market, maybe what. Okay, so these are grabs. You can see the market has been grabbing people's stop losses here. These are grabs. So those are grabs. Okay, if you don't know it, it's up to you. Just seek for mentorship, then you understand things. Okay, the example is like this. You have $100 account. Now you want to grow it to $1,000 account. Let me show you a trick here. So I'm doing this on a demo account. This is how I always trade. Let me show you it. Okay, me, I will first identify down here. So what's the market doing? It is buying. Yes, I come to the 4-hour. So what is the 4-hour doing? So the 4-hour, they are telling me that. So what is the 4-hour doing? So we are going to follow 3 things here. We are going to say that okay, so what are we going to follow here at this time? So we talked about, so first I will ask myself, what do you have as a trader? As a trader, you must ask yourself, what? So before taking a trade, what's your trading plan? What are your trading rules, trading journal, risk management, trading psychology? Now, risk and money management here is where people mess up. So risk, what is my risk now? So growing an account is about risk and money. Then trading psychology is going to come in. What are your behaviors? How do you feel when you take the loss? Trading rules, how much are you risking? Trading journal, what's your record saying? Trading plan, So all these things, as a trader, they should be lying before taking a trade. Okay, yes, they should be in line before taking a trade. So let's take the last example. Let's take this last example. You can see, so this last example is going to help you as a trader. Okay, yes, because very few people can show you this method. Okay, so let me show this last example around here. Now the market is buying, but remember it is $100 account. Okay, so this is a 4-hour time frame. Then I will just come as an ICT trader. Now just remember that maybe you're trading ICT. So in ICT we know how to enter ICT. What has the market been doing? So you can see it very well. The market has been shifting. The market shifted. Now this is our recent structure. Okay, coming back. So the market is forming internal. So this is what we call internal structures. Okay, so this is what we call internal structures. So from here up to here and around here, so the market is forming internal structures, bullish internal structures. So we shall expect for a buy. Maybe you want to 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 take a large position, but you have to be good in risk. Okay, let's take 0.1. It's a buy. Okay, so this is 0.1. Now you've taken 0.1. Remember the loss is going to be big. So the first thing is to set your stop loss. So what's your stop loss going to be? So the first thing is to accept this loss. So then, but remember our stop loss should be below this structure here, below the structure. So if you put 0.1, it means that you've accepted to lose $36 because 0.1 is a big lot. Okay, on a $100 account. Now let me take an example here. Then now maybe you've also, so you are losing 30 to make around $60, maybe, or around $80. Okay, so this is an example. Okay, but the best risk to reward 1 to 2. Okay, let's decrease it around here. Okay, so you've taken a buy. Now this trade is moving. How do you manage this big loss? So this loss is big, 36. How do you manage the loss? Okay, so that's where the point is. So to manage the loss, if the market moves 10 pips, so that's where we are going to manage our loss. So we shall have to decrease this loss in the 10 pips zone. Okay, we shall have to decrease the loss in the 10 pips zone. Then it is going to depend how much the market has moved. Okay, so that's going to depend that how much has the market moved. So then we shall have to reduce the stop loss to the 10 pips zone. 10 pips means that the market has moved 15 pips or 20 pips. Then I will have to set my stop loss again in $10 profits. So this is how we can manage also losses. Okay, so I will demonstrate it in my intermediate class. Okay, this new month. Okay, that's the idea. Okay guys, let's stop here for today. So for those of you who are on the YouTube channel, guys, so the video is there, so it's already playing there, so you can just go and check it out. Just ask any question about the business, about maybe you want to get more knowledge about where to start from, which things are you required to do. So you have to put it comment section, watch and comment. Okay, so don't be a good participant. Okay, don't be a good participant. Okay, don't be a good participant. Maybe you want to be a good participant, you want to watch, like these people who watch football, they go in the field, they don't participate, but they can also give you knowledge about the player, that what if you change this player, so they know nothing if they had been taken in the field. So don't be like those people. You have to participate. You have to be an active partner. So in a business, there's what we call dormant partners and active partners. Okay, dormant, active pattern. Hmm? So who is an active pattern? You have to get involved in the business. Dormant pattern doesn't work. In this business, we don't have dormant partners. So if you're dormant, then you're not going to, it's not going to work for you. Okay, so we have demonstrated this trade. I've told you that after taking this trade like this, so the position is 0.1 on $100 account. Now, how do you manage this loss now? Remember, the loss is $2.55. How do you manage the loss? Then you have to know when to cut losses short. Let's say here to be $23, here to be 30. So when do you cut losses short? That's the best good question as a trader. Cutting losses short. Okay, how do you cut losses short? Okay, as a trader, how do you cut losses short? But remember, if I see my graph here, the weekly graph here, so how do you cut your losses short? So it's the most important thing now. Losses short. So how do you cut losses short? That's the most important thing now. So you can see, okay, you can see that the market is changing after liquidity sweeps. Okay, so what are we expecting in this market? What are we expecting? So we are just expecting longs. So for a swing trader is expecting this. Stop loss is below here. Okay, so this is swing trading, guys. But if you're a day trader, don't set your stop loss up to this side. For a swing trader is like this. Maybe you're a day trader, your stop loss should be within here, because you don't have capital, set it within the zone. Maybe, but if you want to hold this trade up to next week, then you have to increase the stop loss side. Okay, so this is where one, accepting the loss. Are you willing to handle that big loss? So if the answer is no, then you are just move out. If you can't handle the loss side, close the trade. Don't waste time watching your account going. No. First measure, are you willing to handle the loss? Okay, you're a day trader. You are a day trader now. You're a day trader. Let's go to the 15-minute time frame. 15-minute time frame. Okay, 15-minute time frame. Okay, as a day trader, though this chart is not clear. Okay, but as a day trader, what should I expect now? So to handle the loss, maybe your loss is tight. It's very tight here. You are risking this, and you're targeting the nearest liquidity points. So you have to target the nearest liquidity. What's the nearest liquidity points? Okay, that is it. You're a day trader now. So now, all these points here down, all these points down here, this zone. So this is what we call liquidity sweeps. This is what we call liquidity sweeps. So the market has been sweeping and grabbing. So these areas are, so market has grabbed people's stop loss. So most of the retail traders were putting stop losses here. So the market had to grab them very, very fast. You can see it here on the 4-hour time frame. So the market grabbed everyone here. So the market was busy grabbing people. Okay, so Okay. Okay. So just a take. So the video is going to be on YouTube. Just put a comment around here. Put a comment. You are going to find the video on the YouTube, and I'm going to upload it there. Okay. So it will be help you for future reference. Maybe you want to understand more about smart money trading. What? So you want to advance your strategies. You want to trade like a pro. Eh? Trade like a pro. It's very easy. You have to have the right knowledge and the right skill in trading. Knowledge and skills. So if you have knowledge and skills, then you can grow an account. Even $10 account, you can make money on $10 account. $10 you can make. You deposit $10, maybe you grow up to $100. Yes, it is very possible. Yeah. Once you also understand the things we have been talking about this week, and most of the people who are in the private mentorship, make sure you show results. Okay. Okay. We have taken this trade. Yes, I told you this. Now let's have a look, guys. So this was an example. So we took the trade. So we executed 0.1. Now, how do you manage the risk? So if you've been in the mentorship, just put a comment. How am I going to manage this risk here? Remember, I've taken a loss of $36 down here. So how am I going to manage the risk? So I'll just come to risk management first before profits. So I'll have to reduce my stop loss now to around $4. Okay, reduce the stop loss. So this is what we call risk management. So this is 0.1. Okay, you have seen it. So this is how trading is. So this is the risk now. Okay, so let's stop here, guys. Okay, but if you want more and more, most of the things I don't show them here. If you want more and more, maybe you want to be a pro, you want to learn ICT trading in a circle trader, you are welcome. Supply and demand, you are most welcome. Support resistance, you are most welcome. Smart money concepts, so you can become a master in any strategy, but though there are strategies which cut across. Okay, yes, you can also make. So 3 levels. We have beginner, intermediate, and advanced. Okay, so this is it, guys. Okay, all right, guys, let's stop here for today. Yeah, so if you've taken this trade, take it. So the market is buying, so Bitcoin is buying, so just take the trade, set the stop loss, and if